So you want to buy a business, but you're not sure if your finances will stretch to cover the whole purchase or even any of it. Well, your dreams of becoming a business owner just got a little bit closer. Setting out on the journey to acquire a business can be both exciting and terrifying, especially when it comes to navigating the financial aspects of the purchase. At Empire Flippers, our marketplace for buying and selling online businesses, a popular and sensible approach to financing new acquisitions is through a mechanism known as earnouts. And this method not only helps with a smoother transaction, but also provides a cushion to buyers who may not have the entire purchase amount up front. An earnout is essentially a financial arrangement where the buyer pays a substantial portion of the purchase price in cash and agrees to pay the remaining balance to the seller over a specified period of time. To show what I mean in an example, consider a scenario where a buyer opts to pay 80% of the business cost up front, while the remaining 20% is scheduled to be paid over an agreed upon time frame between the buyer and the seller. Now, this strategy can be particularly beneficial when dealing with larger businesses or in instances where the seller encounters difficulties in securing a buyer. It works both for the seller and the buyer. Now, the beauty of the earnout lies in the flexibility that it offers, enabling the buyer to utilize the profits generated from the business to fund the acquisition. However, it is important to note that even if the business ceases to operate or fails to generate the expected revenue, the buyer is still typically obligated to fulfill the earnout amount unless the contract explicitly states otherwise. Now, earnouts can be broadly categorized into two types, each with its unique characteristics and applications. The first is your fixed or your time-based earnout, which entails paying the remaining amount, the earnout amount, over a predetermined period. So for instance, the buyer might agree to make equal payments every month for 6 months until the entire earnout amount is settled. On the other hand, we have the performance-based earnout, which is where the repayment is contingent upon the business achieving specific performance milestones, which are mostly commonly related to revenue. Now, this means the payment of the earnout is triggered only when the business hits a particular revenue target, aligning the seller's payout with the future performance of the business. Now, earnouts are pretty common, but what if the seller isn't open to this type of deal structure? For example, what if they need the cash now? And that's where we get into specific online business lenders. So sometimes your upfront payment will need a little bit of a bump. And with online businesses getting more popular and institutions taking them more seriously as real businesses, industries and lending companies have been built to support lending directly to online business purchases. Companies like Funding Circle, Lendio, Bupos, these are examples of such companies that offer distinct pathways to secure online business acquisition loans. Now, full disclosure, these are companies that I did some quick research on, and I haven't personally worked with them, so you'll want to do your own research to determine if one of these companies is right for you, depending on the kind of acquisition that you're looking for and their lending terms. But just to give you an idea of what options exist, Funding Circle offers various funding options such as SBA loans, which are small business administration loans, business term loans, and business lines of credit, each with its own set of advantages and terms. For example, their SBA loan allows borrowers from $75,000 to $5 million with term lengths of up to 10 years, and the funds are delivered 3 times faster than the industry average. However, SBA loans are difficult to secure for online businesses, which I'll talk about in just a little bit. Now, on the other hand, Lendio provides a range of business acquisition loan amounts from $250,000 to $5 million, tailoring the amount based on various factors like your credit score, the company revenue, and existing debt. Lendio performs a thorough credit review, analyzing revenue and debt, ensuring a minimum down payment, and presenting a business plan to secure that loan. So their platform prioritizes that businesses can safely manage the loan payment and really trying to create a secure financial future for both the lender and the borrower, and understandably trying to create the most secure lending agreement possible. Now, just as a side note, if you do happen to see the business of your dreams on the Empire Flippers marketplace and you want to consider lending or financing options, feel free to reach out to us with your questions about this, and we'll do our best to help you understand the seller financing options or point you in the right direction for lenders. Next, let's talk about traditional lenders. So outside of online specific lenders, there are still the traditional routes, and the conventional financial institutions such as banks still consider online businesses kind of uncharted territory, primarily because of their lack of physical collateral and really a traditional framework for evaluating risk and financial stability. Put simply, because the bank can't point at a physical location or inventory, they often struggle in assessing their risk. And if the business began to struggle, they can't send a team to portion off physical assets to cover any of the debts. Now, this is particularly true for small business administration or SBA loans, which are known for their strict criteria and their careful evaluation process. And this is the reason why at Empire Flippers, we don't really advertise that you can go get an SBA loan, just because of how historically difficult they've been to acquire still at this point for online businesses. But if you do find that the traditional loan route would actually work for you, business acquisition loans are generally structured as term loans where you have to repay the borrowed funds along with interest over a predetermined period of time. And although you might request a specific loan amount, some lenders might only offer a percentage of funding, meaning you'd still need to cover the remaining percentage as a down payment. And the down payments on business acquisition loans can range from as low as 10% to as high as 30% or more, depending on the type of financing, the lender, and your business's qualifications. And lenders typically rely on the business's valuation to determine the loan amount to offer. Other factors include business assets, the future earnings, and the current market value to get a fair assessment of what the business is worth to them. And in some instances, collateral may also be required to secure your financing. So we've covered new ways to structure deals, and we've seen some examples of how lenders operate. Now, this next method is one people normally miss, but could be the solution to your problem, and that is pooled resources. So pulling together resources to fund the acquisition of a business or even multiple businesses is a strategy that's really gained traction really amongst novice and seasoned entrepreneurs. And this approach, which involves creating a fund or forming a multi-group partnership, is a pretty savvy financial strategy that's been proven to be effective in various instances over the past few years. If you've previously owned a successful content site or an e-commerce store and have a clear vision and strategy for growing other similar businesses, pooling resources with other people could be a viable option. It's about having a specific actionable plan and then gathering the necessary funds to bring that plan to reality. So in the past few years, especially in 2020 and 2021, we really saw this strategy being implemented on both small and large scales, with some of the largest groups often referred to as aggregators, which at that time, one was valued at even over $1 billion. And these aggregators typically have a pretty robust strategy for acquiring, optimizing, and scaling the businesses under their umbrella of their portfolio of businesses. Often it's in the e-commerce sector, but I've also seen this for content sites. And you do see this in the larger business world, such as I've recently seen Jarvis acquiring tons of these small GPT-focused SaaS writing tools. But let's get back to how this applies to you. Consider a scenario where you assemble a group with diverse skill sets and experiences within a specific business model, such as an e-commerce business. Imagine having a team where one person excels in advertising, another in inventory management, a third in working with manufacturers, and a fourth in product research. This combination of skills forms a kind of dream team where each member brings a unique skill to the table, enhancing the collective capability of the group. And it could also provide a way to, of course, reduce individual financial strain. For example, 4 individuals could confidently purchase a $100,000 e-commerce business by each contributing $25,000, or maybe performing a combination of an earnout and pulling together resources for the remaining amount that you have to pay for the cash up front. So with combined skill sets and reduced individual costs, you or this kind of group could nurture and grow a brand that already demonstrates a strong product market fit. However, it is crucial to tread carefully when pulling together resources, especially when accepting money as an investment. Just make sure that if you do want to consider this pathway, that you understand the legal requirements and that you're ensuring compliance. Whether you're forming a partnership or starting a fund, ensuring that all legal and financial aspects are meticulously addressed is very important. And this involves clear agreements on investment amounts, roles, profit sharing, and a whole bunch of other factors. So as you can see, there's a lot of creative ways to fund a business acquisition. It just requires you to understand the moving parts of the ecosystem that you're looking at entering. And if you want to better understand that online business ecosystem, feel free to sign up for our free newsletter down below. It's called This Week in M&A. And if you want to understand the math of an online business acquisition and what it looks like to resell it, To understand really how powerful this can be as an investment strategy, then click on the video here. So thanks and see you next time.